Okay, Dan, I know that you've been skeptical of this market's overall direction, though allowing for some of the spikes we've seen. Well, what's your take? Fill that out on what's happening with yields right now and how it affects stocks.
Sure. I mean, I was expecting a rally. You had me on an interview on April 7th, and I said, look, I think we might see a short-term bounce because you get these bear market rallies in the midst of these sell-offs. And, if you go back and you look at the global financial crisis as a good example, you had two rallies in the S&P of 18 to 19% on your way to new lows. You want to go back further to the tech bubble, you had three rallies actually between 19 and 21% in the S&P 500 on your way to new lows.
So you think we're getting new lows?
I wouldn't rule that out in the fourth quarter. And here's the reason why, John. So you brought up yields earlier, obviously. That's something you got to pay attention to when the 30-year is bumping up against 5% and the 10-year is bumping up against 4.5%. And the question you asked is, well, if you look at those yields, why are they doing that? Well, yes, tariffs, thankfully, on China have gone down from 145% or so to 30%. I think they ultimately will go closer to 10%. But at the end of the day, tariffs overall are going from about 3% to start the year globally to probably low double digits. That's inflation in the pipeline. So I don't think the Fed's going to cut it all this year. The more important thing is if you look at the U.S. economy, we're about 1/4 of the world's GDP. We had a 41% increase in imports in Q1. So when you pull forth that much demand because people are scared of tariffs, Apple airlifting 600 tons of iPhones, and you have consumers going out and buying PCs and cars and whatever else, you're going to have a payback during the holiday period. And to put it in perspective, during COVID, you had an 88% increase in the third quarter. But that's because you had imports go down 12% in the first quarter and 54% in the second quarter. So you were just doing catch-up.
To clarify, you're saying we probably ended up pulling everything into the U.S., not everything, but almost everything we need for the entire year in these first two quarters in the first half because people are trying to get ahead of tariffs?
Yeah, absolutely. I mean, you heard it on the Walmart conference call where they're like, we can't adjust to this and we're going to have to start raising prices. And you've seen this interesting thing where imports surged in Q1, then they collapsed in the month of April. Then when the tariffs got rolled back, they've started to surge again. And so all you're doing is you're just pulling forward an unbelievable amount of demand. I mean, think about it. 1/4 of the world is the United States, and imports were up 41% in Q1. You don't think that pulled forward some demand?
So then what's the impact on things like jobs, whether we're talking ports or warehouses, et cetera, when the demand for new goods from overseas dries up, regardless of what domestic consumer demand is doing if the supply is already here?
Well, and that's the problem, because you go into the holidays. What's amazed me is how many companies on their conference calls for Q1, because remember, Q1 earnings came in better than most expected. I expected them to be good. If you go back and read what I said going into this earnings season, because I thought the pull forward in demand would make companies sound optimistic. I thought there'd be a rally through early May. We've obviously gotten that. But the thing is now, you look at the estimates for the full year, and the third and fourth quarters haven't been cut. So either you believe tariffs have no impact, inflation coming through the pipeline has no impact, yields up here have no impact, and you're going to get double-digit earnings growth for the full year, or you're going to walk into a situation much like, if you remember, in 2021, the S&P went up 27%, even though inflation surged from 1.4 to 7%, because everybody wanted to believe it was transitory. Then you got into 2022, and the S&P got clobbered for 19%. And I think that's kind of the situation you're in. I think because of underpositioning, you're going to see guys chase. It wouldn't surprise me if you get to new highs on the S&P because people want to believe that everything is great. And then you got a huge issue in the fourth quarter when holiday sales don't come in.